The problem is that's what employers that understand the game like you do, they're funding that plan, most or all of that plan. And you need to, because otherwise you get what we call the death spiral. Like I could tell stories for an hour about groups we've walked into and they have 150 employees and 12 on the plan, and they're wondering why the rates go up every year. And that you don't ever want to be in that situation. So our consultants that in this office and across Texas, they're really good at advising and helping employers on that. You've got to keep a plan with good participation, which usually means, to your point, paying the lion's share of some base plan and then give multiple options. But that doesn't necessarily mean most employees love and just, carry around the HSA flag in the back of their truck every day.
Good morning, HR. I'm Mike Coffey, president of Imperative, premium background checks with fast and friendly service. And this is the podcast where I talk to business leaders about bringing people together to create value for shareholders, customers, and the community. Please follow, rate, and review Good Morning HR wherever you get your podcast. You can also find us on Facebook, Instagram, YouTube, or at goodmorninghr.com. We're approaching the beginning of the third quarter, which for many organizations means the dreaded open enrollment period is just around the corner. My guest today is Matt Morris. Matt is the area president of Hub International in North Texas. He has over 20 years experience in insurance and investments, and we've known each other for a long time. I watched as he helped build Gus Bates Insurance and Investments into a North Texas powerhouse, and then, after Hub International bought Gus Bates, managed to keep the firm's community and relationship-based focus despite being part of a much larger organization. Welcome to Good Morning HR, Matt.
Thanks, Mike. Appreciate you having me, man. We're excited to be here.
Well, I'm glad you made it. So we're in the dog days of August. This episode's being released on August 8th. For health insurance plans that renew on January 1st, is it too late for an employer to start evaluating changes to their health care plan this late in the year?
Good question. For most of them, no, sir, it's not. There's a lot of them in the middle of it right now, depending on the group size, depending on the market segment that they're in. The real large jumbo accounts are obviously well down the road on that and probably making some final decisions. But if you're under 500 employees, which the vast majority of employers in Texas are, I would say it's not too late for most of them.
So we have an employer-provided plan at Imperative, and we had cost increases last year. What were the average cost increases you saw in y'all's clients, at least, in coming into 2024?
That's a great question. It's really all over the board, and I would argue that it's all over the board every year. There's some trends we see, like three renewal seasons ago. Blue Cross had a really bad run, which was not the norm for them on the fully insured side. But some of the fully insured stuff is just roller coaster. On the self-funded side and on the alternative funding piece, which we're going to talk a lot about today, I think it's really all over the board, depending on the client and what their strategy looks like, what their plan looks like. We have groups every year that get passes, get decreases. We have some that get huge increases and have to work, angles depending on what levers they can pull with the strategy they've chosen with us or their broker, what their plan looks like.
And is that mostly because of experiences they've had in the prior year?
It is experience and then the product that they're on. Yes, sir. Whether they're on a pooled product or a captive or a partially self-funded arrangement or fully insured. Fully insured, you have the least amount of control, as you probably know. So it's more of a pooled, product with some tweaks to your plan design. But the game's changed a lot since I started in 2002, and we now have a quiver with 7 or 8 arrows, and it's growing every year, especially with the Hub world and the tools we have to help them with that. So it's a good thing that we have more options now than we did 20 years ago.
So smaller groups like mine, 20 employees, traditionally have just gone to the fully funded, fully insured plan, and we just shop every 2 or 3 years. Make sure you shop around, you find out whoever's going to give you the best rate for whatever your plans are. But you mentioned, all these other alternatives, and I'm going to get into a lot of those today. But at what point do those alternatives start making sense for smaller organizations?
That's a great question. So when I started in 2002 with Gus Senior and Gus Junior and about 5 other employees, it was fully insured or fully insured unless you were several hundred employees. You closer to, I would argue, to 500 to 1,000 is where the self-funding discussion started. And backing up before some of the stuff we'll talk about, the fully insured dynamic still exists today. A lot of our clients are fully insured, especially in that smaller segment. So to answer your question a little better, in Texas, under 50 lives, as you probably know, is really a product of your demographics. It's with the underwriting changes through Obamacare and different things. It's your gender and your age, your gender and your census, your zip code mix that spits out the rate under 50. So there's some things like we have a Hub Texas private exchange that's really nice and gained some steam for those smaller groups that works well. That's a carrier that most brokers don't have access to, and we can kind of do some different things there. But for the BUCAs, we call it BUCA in the industry, Blue Cross United, Cigna, Aetna. There's a few others in the under 50 space. You're really dealing with kind of canned products and what you can do within that, which the hard part for those employers, as you know, is that most groups have already gone and ran the gamut of HSA, HRA, high, multiple options, different things within your plan. And now it's when you're down to your base plan, the plan you fund off of as an employer being a high deductible, you're kind of out of some options on some of that, which is why, thankfully, the alternative funding market, level funded, self-funded, captives, et cetera, has really come downstream. I would say that we have cases now that are below 100 lives, which did not exist 10 years ago, that are looking at all those different things. So it's really changed a lot.
I think a lot of employers my size, under 50, have some sort of, depending on how much, I mean, and we pay 95% of our employees' contribution, of our employees' premium. They've got a very small contribution because, quite honestly, my employees are young, and I just found I couldn't get them to pay for insurance if and then,
Sure.
I was always worried something would, and it's a little paternalism on my part, but I was worried if something goes wrong for them, they're not going to have the ability to cover, to cover it. So we cover about 95% of their premium, and we've got high deductible plan with an HSA. Is that where you see most employers of that smaller size doing? And then what are most popular things as they get up in that medium employer size?
Yeah, no. So in that smaller employer segment, which some carriers define it under 50, some under 100, right? Depending on who you're talking to and how you define small employer. Yes, a lot of them have a base level plan that the employer is funding off of. That's the lower cost plan. It might be a high deductible with copays. It might be an HSA option or both. The problem is that's what employers that understand the game like you do, they're funding that plan, most or all of that plan. And you need to, because otherwise you get what we call the death spiral. Like I could tell stories for an hour about groups we've walked into and they have 150 employees and 12 on the plan, and they're wondering why the rates go up every year. And that you don't ever want to be in that situation. So our consultants that in this office and across Texas, they're really good at advising and helping employers on that. You've got to keep a plan with good participation, which usually means, to your point, paying the lion's share of some base plan and then give multiple options. But that doesn't necessarily mean most employees love and just carry around the HSA flag in the back of their truck every day, because it's a high deductible plan with no copays. And there are some newer things out to the market you've probably heard of with Surest and Curative and some other things these carriers are launching or have launched that kind of run a different play against that. For 10 years or more, that was the thing to do, is put in an HSA, have the employer try to fund a little bit of that or match a piece of that, like a 401k match,
Right.
to help consumerism. And then the reality of it is you've got to be able to open a bank account, and you've got to be disciplined enough to put money in the bank account every paycheck, or those things don't work very well whenever something happens, because we all get older and things break, and none of it's under $500. Right? So these other newer plans that you will see a lot about, if you haven't already, from your current broker, are catching steam. They're popular because they're not an HSA chassis. They're more of the old school HMO kind of chassis, but the copays vary based on quality and cost of care. So there's multiple copay levels that help drive the care, as opposed to a high deductible with no copays and hoping employees open a bank account and put money in it every paycheck on top of already being paycheck to paycheck to pay their other bills. So there's some options there that are new too for the smaller market and the larger market that are taking off as well.
So you mentioned quality and cost of care, and I think that's one of the, and I know this, I'm a board member of the Texas Association of Business, and it's been one of the things that the State Chamber of Commerce here in Texas, one of the things we've really tried to work on over the years is that transparency about quality, from providers about quality and cost, so that, and mostly around emergency rooms. That's the big conversation, right? But you get in there and, my employees' illness maybe even needs a procedure of some sort. What are either the brokers or the insurance companies doing to help employees understand where to go and understand what their cost out, what things are going to cost before they make that commitment to draw it out of their HSA or pay it out of pocket?
No, it's a good question. So there's been lots of vendors and partners and carriers attack that, right, through things like healthcare blue book and premium designated copay plans that some of you guys have today, probably with United Healthcare and Cigna and different, where you'll have different levels of copay if you go online and you figure out which providers charge the higher or the lower copay, which in theory is tied back to their cost of care or their relapse rate, their different things like that. So that's been out there for years. The human nature effect of it, though, I always say is the hard part, because you have to rewire people's brains to go use those tools before they go where their doctor already pre-scheduled them down the hall with their buddy or whatever, right? So some of these other things we're talking about have that solution built in that don't require you to think to do it because the copays have already driven you that way. And that's kind of the problem with the HSA too, even though we love them. I'm on HSA, been on one for 20 years, and I'm a huge HSA fan, but I understand it. I budget for it. I put money every side and I don't think about it. That's not most of America that does that, right? So there are some of these newer plans out that allow you to design your plan so that the plan design steers the behavior, as opposed to having an app or a carrier website or all these things that are already out there, healthcare blue book, for example, and then employees having to remember to go do that before they access care. That was the breakdown, in my opinion, of those models, and it's being improved as we speak.
So in those cases, they can get on their carrier's app or something like that and say, and do some comparison to figure out, who do I go to? I need a dermatologist who's on the plan. That's always a start, but then the dermatology is often not even covered by the plans. And so then you have to get in there and figure out who's got a negotiated rate or something like that. Is that generally how those things work? Yeah.
That's right. That's exactly right. And then building those resources and those habits, because you do have to teach people to do that, which is education, right? That's not just a widget or a AI or a slick enrollment system that teaches people to do that. The tools have been out for years. It's just that we've got to integrate that, which is the key word, with plan design. And I think that's what some of these, like I mentioned earlier, are doing. And that's what we're doing in our larger plans as well, or I say larger now, 50 plus type plans that are doing the level funded and self-funded and captive stuff.
And I know back when I was in corporate HR, back in the dark ages, all of that responsibility, especially in a large organization, fell on somebody in benefits and HR to communicate that to employees. And often their understanding was, and they didn't have as many, fortunately back then, as many options as they have today, because they didn't have the technology to support it. But now, for especially small groups, I think that's one of the real values that companies get from a good broker, is the ability to, to have somebody who can really help an employee navigate that process. So it's not on, if they even have an HR, function, it's not on an HR, that one HR department of one, or that small HR group. They may not even have a benefits team. And so relying on your broker is really key. And I definitely want to get into selecting a broker, because I think that's something that a lot of people misunderstand, because they're looking for the very best rate on their premium, and that's not necessarily how you want to do it. But let's get into some of these other products, because you mentioned HRAs. Okay, let's start with that. That high deductible health plan is typically what, a $5,000 or a $10,000 deductible? Is that generally the range on those? And then you're hoping the employee has the money in their health savings account that they've set aside to cover that.
Yeah, the government defines it a little differently based on tax, limits and stuff. It can actually be, it's less than 5,000, but no copays. It's when we talk about HSAs, we're talking about plans with no copays. An HRA, a health reimbursement arrangement, can be a high deductible plan of any amount that you consider high, 3, 4, 5, 6, 7,000, with copays or without copays. Technically, an HRA is just a reimbursement mechanism where the employer is reimbursing after a certain level. It's like a mini self-funded plan, right? Where in traditional self-insurance, the employer, are on the hook for the first $50, $100, $200,000 per belly button in claims. An HRA limits that to, $2 or $3 or $5,000, whatever you want to design. It's a whiteboard of how you want to design it.
So the HRA is a reimbursement from the employer for those expenses, where the HSA is the employee setting money aside for their.
That's right. That's right. And those have been out for a long time. For my first 10 or 15 years of my career, we would put a lot of those in, still have them on the books, some of them. And they work. They're clunky at times, especially the HRA can be somewhat clunky. Multiple systems, the employee has to file an EOB and get reimbursed, and there's a process for that. Some of the carriers have made it a little better with integrating those, but it's nothing like what we're into now with some of the next level stuff. it's gotten a lot better when you want to take on a portion of that for sure.
So let's get into some of those, these newer tools. It seems like I first started hearing about self-funded plans for smaller employers that weren't, Lockheed or somebody of that size, maybe 10 years ago, 10, 12 years ago. And, you can't go to an HR association meeting or a chamber of commerce meeting without 15 benefits guys coming up and giving you their cards and telling you how they're going to change your life.
Yeah,
And I will say that that's one of the great things that y'all do at Hub International. Y'all are so supportive of the HR associations where you're doing business, and you provide a lot of education and information. And I'm a big believer for anybody who's in a vendor role in the HR world. You go to these HR association meetings, these conferences. The best thing you can do is be helpful and education oriented, and the sales will come to you. You
right.
don't have to do that used car salesman thing. But and
That's
I'll
right.
just say, I'm not getting any money from this, but your guys have always been amazing on that front. But so let's talk about what that self-funding seemed really complicated when I last looked at it years ago, and it seemed like a really high risk thing for a smaller employer. How has that changed? And I know there's this thing called level funding that's a little different. So talk about those products.
Sure. And I'll bridge the gap before we jump into that with something you said a minute ago, which I want to touch on because I forget it. You're exactly right. And how many we still run across companies, Mike, with 20 employees, 100 employees. I was with one with our team the other day, had over 100 employees, and HR was doing everything. I mean, they were doing, in our opinion, they were doing half the job with a broker. And it just baffles me that that's still out there. So I think that's a casualty of our industry too. Our industry is built on relationships, and you guys all know. I mean, I used to get frustrated because I'm a grinder type. I don't even play golf. I'd love to be able to play golf. I'm not good at it, but there's a lot of business won in social settings on the golf course and all that kind of stuff. And I respect that. That's our industry. But then you look up and you see an HR team of one or two or three doing the job of the broker a lot still. And that just baffles me. So it's that when you talk about education and how to use a health plan, especially when you start designing what you're asking about now, some of the alternative funding methods, now you're kind of mixing the lines of, some financial discussion as well as the normal HR benefits discussion. And it really gets complicated. So choosing your broker and having a broker partner, whoever it is, that really does their job, quite frankly, to say it directly, and not just brings rates on a spreadsheet once a year and takes you to lunch mid-year and calls it a day. I mean, that was 25 years ago, and it's evolved to so much more now. So to get into what you're talking about, level funded is probably the easiest first step. There's a lot of groups that are on that, have been to that. Back when you remember Cigna bought Great West. Great West had a level funded product forever. Cigna purchased it many years ago, kind of boosted it even more. And then you had United Healthcare and All Savers that entered the scene. And I would say those are two of the bigger ones that we still use. And it's a good product. It's kind of a tweener product where you pay a fully insured premium. It looks, smells, and feels like fully insured all year. But on the front end, going into it, if my claims spend is less than X, I get a refund. So, the first, I won't say the name of the group, but the first group we ever put on it was about 200 employees, 180, something like that. And I'll never forget, they got a $68,000 refund check and they were over the moon, just excited. It worked like it was supposed to. But then the longer we did it and the more we really started looking at a bunch of groups that were on it, you live and learn, just like anything. You start to realize, man, those refunds are few and far between on a lot of those because the fixed cost is so high. The carriers are smart. If you look at all their stock returns, look at the market, you'll see how smart they are. I mean, I love our carrier partners, don't get me wrong, but we started digging the onion back and
I like
going,
going to Caesars in Las Vegas too, but I understand how it
yeah,
works, right?
yeah. I mean, they're great people and we have to have great relationships with them. I'll never kick them while they're down or anything like that. But the reality of it is the fixed cost on those level funded plans is really, really high. You can get
So let's define a level funded plan, because I'm not sure if let's tell me if I'm right or wrong. Okay, so it's basically a self-funded. Let's start there because that's the one, that's the
sure,
easy one to understand, right? That's the
right,
one where I, as the employer, I'm just, as expenses come in, I'm paying it.
right.
And then maybe I've got some sort of supporting stop loss insurance to cover a certain amount over a certain amount. Is that right?
That's correct. Self-funded. There's two ways we do self-funded plans: bundled and unbundled. And bundled just means that your carrier partner, Blue Cross, Aetna, Cigna, whoever, they own it all, right? So they're the administrator, they're the stop loss, they're the pharmacy piece. It's all under that logo. Your ID card still says United Healthcare, Blue Cross, whatever. That's bundled self-funding. That is the same as level funded. The difference is level funded, you don't fund claims every week. You don't get reports every week. It's a lot simpler model. Like I said, it's kind of a tweener model for fully insured smaller groups that say, you know what? I'm spending $1 million in premium over the year right now, or 100,000 or whatever the number is. I understand if I do that with level funded and I run below X, I can get a refund. So it's kind of baked in behind the scenes. It's on a self-funded chassis, so you save some state premium taxes. There's compliance wins with it, but it's really kind of if you ever seen the old, and most people have not seen these, but there's a term life policy you can buy on yourself, individual life policy called a refunded premium life policy. And if you buy a 20-year term life policy and you outlive it, you get a refund back. So that's kind of what level funding is, but on the health insurance side. Although, like I said, the bigger the group, the more advantageous or attractive the traditional self-funded models are. And then you get into bundled and unbundled, which is a whole different story.
So with a level funded plan, the employer is paying what feels like a certain premium every month per head, right? I mean, so It's not like I'm not waiting for bills to come in.
Correct.
I'm just paying, okay, this is our claims history. Let's say it's $100,000 or $120,000. So I'm going to pay $10,000 a month into this amount. I'm going to treat it like a premium. We're going to pay out of that. And then when we hit above that, maybe I've got some sort of stop loss insurance to cover that. Is that?
That's right. So you hit the nail on the head. You know your cost, your all-in cost, your total cost per employee per month, right? Employee only down to family tier on level funded for the whole year. It doesn't change. The difference is, you get reports, and we provide those reports. And at the end of the year, if you do really good and your claims come in below expected, then you get a small piece of that back. That's kind of how level funded works. Self-funding, as you mentioned, a whole different deal. You pay the fixed cost. If you take a health plan and break it down, you've got fixed costs, which doesn't change, hence the word fixed per head. It's your stop loss, your administration, et cetera. And then you've got your claims, which is the bigger piece of it. Claims is variable. That's always the biggest part of any health plan. So on traditional self-funding or true self-funding, you pay the fixed cost every month. You pay the claims usually weekly, sometimes every other week, sometimes daily. There's all these options, but it's a variable cost. So the company, has different involvement, more different cash flow, et cetera, with the claims piece. There's caps and limits and protection on it. So, you have, some stopgap, but it is a variable cost every week on the self-funded piece.
And on the consumer side, can you still have an HSA if you're participating in one of these plans? So, I mean, because I think one of the big challenges we've got with healthcare in the US is that the people who are receiving the services don't often have much of a dog in the fight as far as the cost goes. And so giving the employee some incentive, especially when you're self-funding or level funding, would seem to be the incentive for the employer to make sure the employees do what they can to manage costs. You always want your employees to go get the best care that they need when they need it, but how do you control cost in a plan like that?
Yeah, no, plan design. It's exactly, you hit the nail on the head. It's plan design. So all those things we talked about earlier, HSA, HRA, Good RX, all the transparency tools, Health Joy, Healthcare Blue Book, and so forth. And the carriers, the BUCA carriers have a lot of them too. All that applies or can apply in self-funded and level funded as well. But that's how we control cost or should control cost, is through changing behavior, rewiring our actions to use those tools or those plans to drive the cost down. Because let's be honest, transparency's come a long way, and you mentioned that, but it's still not to where you walk into the hospital and everything's posted like it is at the restaurant, right? So we may get there, and we are making strides on some of that, but a lot of this stuff, you don't know the cost till you get the bill, especially on the bigger stuff. That's why these tools are real important, because they can at least estimate, if not, some of them tell you to the penny, depending on what the version you're on, of what these things cost. So that the plan design piece is the same. There's multiple options. The funding is not the same between self-funded, level funded, and fully insured.
And let's take a quick break. Good Morning HR is brought to you by Imperative, bulletproof background checks with fast and friendly service. HR leaders are often approached by other parts of the organization with a request that they run a background check on someone for a legitimate business purpose, but not an employment-related purpose. And because the laws regarding employment background checks are totally different from any other kind of background check, and most employment background screening companies won't even run other kinds of checks, the HR professionals think they have to say no. While for the last 25 years, Imperative has been the best source for employers who want to make well-informed hiring decisions, we also provide a variety of other due diligence background investigations. So whether your company needs to check out a potential service provider, needs help with the due diligence on an investment or acquisition, or maybe your legal department needs a litigation-related background investigation, Imperative is here to help. You can learn more at imperativeinfo.com. If you're an HRCI or SHRM certified professional, this episode of Good Morning HR has been pre-approved for 1/2 hour of recertification credit. To obtain the recertification information, visit goodmorninghr.com and click on Research Credits. Then select episode 160 and enter the keyword benefits. That's BENEFITS. And if you're looking for even more recertification credit, check out the webinars page at imperativeinfo.com. And now back to my conversation with Matt Morris. So what we've got level funding. What are the other kinds of pricing that are available, or kind of plans that are available to especially small to medium-sized employers?
Yeah, so I'll start with the kind of medium and up, right? That's where some of our work has been the last 2 years since we joined Hub in 2020. And I'll say even before we joined Hub, Justin Phipps, who's in our office, and myself and Cami and Peter and a lot of our senior folks, we've had cases on captives for a long time. We've had cases with the Berkeley captive and with AIG captive and Pareto. Pareto's probably the largest, and we have a lot of business with Pareto nationally. Captive is a next level self-funding thing. And to explain it as simple as I can, it's a self-funded chassis. It works, looks, and feels like self-funding. It's unbundled, usually, meaning it's not all with one carrier. One carrier doesn't own it all, and that's for cost reasons. I mean, when you start peeling out your stop loss, your pharmacy, your administration, your tools and resources, there's some serious cost savings you can get to there, but you've got to integrate that stuff. And that's where all these captives I just mentioned have been somewhat clunky through the years of how do you, if you peel all that stuff out and you bolt on a plan that's got best in class savings, savings, you save a bunch of money, but now you have an unbundled or a bolted on plan. And when employees go to use it, they have 7 apps on their phone or try to figure out how to use it. And that's not usually a win on the execution part. So what we've worked in Texas specifically on, and it's actually going to be a national platform before we know it, is something called the Hub Live Oak Captive. And we've built our own to add to the arsenal, add to the quiver with Pareto and the others, which is unique. It's very different. It's got 2 of the biggest networks in the world as an option, Blue Cross and United, which no other captive, to my knowledge, has a choice of those 2. In fact, I don't know if the Blue Cross has ever had theirs as an option. And that solves a lot. Those of you in HR and benefit managers, you understand this, but like when you have Cigna or Aetna or these other rental networks as a captive or no network on your captive or your self-funded plan, you're already buying healthcare somewhat, at a higher cost or more headache. And the 2 that everybody wants is Blue Cross and United because they have huge discounts. They have the brand name and the logo, and they have the recognition there. So we were able to go get the 2 biggest through Trey Smith, our Texas employee benefits leader, who worked at Blue Cross for 20 years, and start there with a foundation and build on top of that, Mike.
So, okay, this is where it becomes really apparent that I spent my HR career chasing managers who could keep their hands to themselves, and I ran away from anything that had numbers associated with it, comp benefits or anything. But a captive plan, as I understand it, is like a multiple employers come together to build a plan, or can you just randomly just pick one and buy into it, or do you have to be part of associations? How do those things get created?
Oh, good question. Great question. So a captive, in our sense, what I'm talking about is really just a shared layer. It's not like all your employees have to get on a Zoom call and make decisions together, right? That's not the case. You're just sharing a layer of the risk. So in a captive plan like what we built, and like some of the others I mentioned, you still get to pick your specific deductible. So the employer, based on their size, based on their risk tolerance, based on their cash flow, can pick, do I want to have a 50,000 deductible per head or 100, or just like you pick your deductible on your property schedule or on your other things in P&C. But the first layer, when there's a big claim that hits over the specific deductible, which is what it's called in our industry, the first layer is a shared layer with multiple employers, to your point. So what it does is it drives down the cost of that risk. You share in the wins and losses. In a good year, you could get some money back or towards a refund or a credit or whatever. It's built in that way from the start, so that you already know there's going to have 10% of the group's going to have a bad year and a bunch of them going to have good years. That's just the way insurance works. So that captive layer is really the definition captive. But because we're able to build it on an unbundled chassis, we've bolted on, like I said, but a lot fewer, not 7, just a few of the best-in-class vendors, and then tied them together through one app with Hub. That is where everybody goes to use it, and that's the secret sauce to what we've built there.
So if I'm looking at a captive plan and I want to go see, what the pool that I'm buying, I'm joining, what their will I typically get the visibility of the, of what their claims history is, so I know what I'm buying into, or do I need to drive past those businesses and see which ones are located across the street from chicken fried steak places and figure out, okay, they're probably too high.
No, you'll get your own data and then you'll get aggregate data on the captive you're in.
Okay.
You obviously don't share individual HIPAA stuff or even claim specific stuff by group with each other. To my knowledge, at least we don't. You will absolutely see your own data throughout the year. And then the captive overall, one of the things that's different about ours is we don't own it. We are not, playing an ownership role. We're not a vendor in this thing. We truly, and this is a Hub thing. Like Hub does not believe in force feeding our own product down our clients' throats. And a lot of our competitors, right, wrong, or indifferent, just how they built it, and it's their model is they will own pieces of it. They'll own the coalition. They'll own the pharmacy piece, a piece of the pharmacy piece, or they'll be the captive manager and all that. We're not. We're in the quarterback seat. We bring best in class vendors and we consult and advise, but we're not going to take a shared piece of that on as far as ownership or driving you to our own product. But you will see your own data and the captive's data throughout the year, and then we make decisions throughout the year and at each renewal based on how the whole thing's running.
So the other thing that I've heard about and don't really necessarily understand fully is reference-based pricing, where I guess they go negotiate the fees or there's a flat amount. How does that work?
That's a good question. And we probably have to have a separate segment on that one just by itself, but I'll try to give you a small version of it. We did a lot of that back in the day too. One time we had 15, 20 clients on reference-based pricing. It's a completely different model where you just take the network, the doctor's network, the Blue Cross United Signet, and you throw it out the window and you build a self-funded plan with no network. Or a rental network. Some of them had rental networks just for doctors or different things, but the reference base is really meant to drive down the cost of care at the bigger ticket items or the hospital, et cetera, outpatient and so forth. So it's a Medicare plus. The reason it's called cost plus or reference base is they're referencing Medicare as pricing, base level pricing, which is public data based on code that's filed, claims code, and it's Medicare plus X, right? So in theory, I loved it. When it first came out, I was like, man, this is awesome. We're going to get everybody on this stuff, and it's going to be Medicare plus 20%, which, by the way, is about 1/3 or sometimes 1/5 of what some of the carriers pay. So it's a huge cost savings. On paper, it can be, but then living it for 15 years, you can ask HR directors that have had plans like this. Sometimes the negatives outweighed the positives, right? Because there was a savings if you had larger claims. If you didn't have many large claims that year, it didn't save you a lot. But the headache and the noise from employees was pretty big in North Texas. Now, other parts of the country works better, but in North Texas alone, a lot of these hospitals banded together. They can't stand it. They don't enjoy it at all. And HR was pulling their hair out, quite frankly, with people running the door because they would tell the employee, you don't have insurance. It's not insurance. Call your HR director. And so there's some things that still are out there with reference base, but I'd tell you kind of one of these things for us and our client base. We still have it. We still show it when a client wants to do it, but it takes a really roll your sleeves up and get ready for ultra education to not have a network on the card anymore.
So we talked about captive plans. What other plans are there? Other plans out there that employers should be considering, especially at that small to medium size, or what else should they be asking their broker about?
The private exchange stuff, which I won't talk a lot about just for time's sake, but we do have a private exchange. Like I said, that's kind of a level funded chassis product only available to us. And again, we don't own it or anything, but we've got an exclusive on it. The level funded still a real deal. And then the getting creative. We call it the power of payroll deductions. You mentioned it, Mike. I mean, one of the biggest fails I've seen in our industry through the years is brokers, and we did it too early on, is they bring you the spreadsheet, you go over you shop the rates, you go over all the options, right? Here's your deductible choices, here's your carriers. But unless you take the time, and it's time, it takes work to break that total premium down into another chart or page to really have a conversation with your employer over what we call the power of payroll deductions. Where are you, the employer, funding, and what are you funding, and how are you funding it? Because the net result of that equation is what your employee's paying. And that's what drives a lot of times, as you know, the first thing employees look at in enrollment is what?
What does it cost? Yeah.
So that's what drives how they enroll or don't enroll or where they enroll. And I would say that's a misstep with a lot of brokers if you don't really dive deep and spend some time with some analysis on who's paying for what, not just what, plans are offered. And that's still a really powerful tool. It sounds simple, but a lot of folks miss it. And it's a powerful tool when you talk to these smaller employers about what are we paying for? What are we funding? How many options do we have? I used to believe a dual option was all you needed when I started in the business. And now you look up and some plans have 4, 5, 6 offerings or more because people are different. Incomes are different. Needs are different.
What about communicating to employees how much a premium costs, what the employer's actual contribution really is? How often do you see employers, especially the small and medium ones? I think under ACA, the larger employers have to do that. Is that right? But smaller employers, I don't think, I hope, because I don't think we do. But I don't ever look at my stuff, pay stub.
Well,
But
yeah.
so what do you say about that?
Well, ACA is more around offering it, right? And the penalties associated with not offering or not paying enough of it, and penalties based on cost. That's the ACA piece. I'll tell you, what you just mentioned is my part of what I'm most passionate in this world about, on the employee benefit space. And the world I'm in now, the role I'm in now, I get involved in a lot of different things besides benefits. So I love this piece when we come back to our teams and I hear them talking about this. And I'll give you a perfect example. Came up the other day with my daughter. I was trying to send her a reminder of something she has coming up with a volleyball camp. She said, "Dad, I have 52 emails from you with calendar invites and emails that I haven't read yet. Can we just talk about it?" And I thought, I went, man, I was thinking about this podcast going, that's exactly how I feel sometimes when I get emails and, stuff on my calendar and tech AI stuff on this enrollment stuff. But sometimes people just want to have a quick conversation, or they want to, like YouTube. There's a reason kids learn from YouTube more than they do reading a book. So the education piece of this stuff and the relational piece of this and how you enroll it is so important. And Mike, we're in the middle of about 8 finalist meetings right now as we sit here today. Larger companies, smaller companies, these are just ones I know about from our team. And what's funny is over half of them have literally said to us, "Hey, y'all made the cut. You're in the final 2 or final 3. Please come and spend an hour, bring your team that's going to work on our account, and don't talk about any more tools or resources. That's all vetted on the front end, right? We just want to meet the people and have a conversation and see what the relationship looks like." And I love that. We all love that in our office because that's who we are. And I think that's the piece as you talk about AI and technology and carrier feeds and online enrollment, all the stuff this industry's been through and keeps going through. I don't personally believe the technology piece really solves the education uh, part of this is best. It may someday, maybe someday a chatbot or avatar can build a relationship and teach you how your health plan works, but we're really big on the education piece. And there's lots of ways we do that.
Yeah. So let's talk about that. I can just say from the 25 years I've been in business, I've seen it change so much. I mean, there was no technology issues back then, and we weren't talking about apps, and we weren't, we were filling out a ton of paper on new hire and all of that. So where does technology fall versus what do you evaluate for customer service, and what are the other criteria you think an employer ought to look at when making a broker decision?
Yeah, no, it's a great question. So much of it this day, that's one of many reasons we chose to join Hub, is that some of those things with technology and with the different tools and resources are you just have to have them, right? They're just rites of passage. If you don't have it this day and age with a large, especially even a medium-sized case, you're just not going to make it to the dance. If an HR team or a benefits manager, an HR team or CFO are doing their due diligence, which a lot of them do when they go through these broker reviews, they're going to see real quick who's got the toolkit and who doesn't. So, and some of that stuff's expensive. Some of that stuff you just don't, wake up and invest 50 grand. You've got everything you need to go win these cases. So with Hub now, we have it all and then some. And it's constantly being developed. So the tools and resources piece is no problem. But the people piece and the educate, I mean, to what you mentioned, when I started, we were carrying around milk crates. Literally had a group of 67 milk crates, English and Spanish, and job site trailers at 7 in the morning doing paper enrollment. Then you went to online enrollment and different things. And now we use Brainshark. We use all kinds of recorded Zooms and team calls, in-person meetings, which we still love if the client will let us do that, if it's conducive to their group and what they need. And then we do fun stuff. This is my favorite part of it, is we'll offer to bring the trailer smoker out and cook barbecue, or do like a wellness fair and have a couple vendors come that are going to be making money from your plan anyways. You might as well invite them to come and spend a little money and provide giveaways and gift cards and some food and different things, and get people together. There's something about that fellowship and that, and I realize you can't do that with everybody now with remote work and multi-location accounts, but you know what? You can do it where you can do it, and you can offer those other solutions for those that are remote or in different areas as well. So we do a lot of that kind of custom education stuff centered around what the client needs and wants, because let's be honest, we can spend all year building the best health plan in the world, saving money, integrated, blah, blah, blah. If no one understands it, we've wasted everybody's time.
And speaking of that getting together, Hub for several years now is maybe you're up to 10 years, I think, first Gus Bates and now Hub, you do this annual leadership conference, and that's coming up, and it's a great opportunity for your certification credit. And I've participated in the past. So talk about that real quick as we wrap up. I just want to make sure we get that in front of our audience.
Sure. And then we very much, you're always a strong supporter of it, Mike. And I can't thank you enough for that, because you and your business and what you do to serve your clients is so right down the lane of what this is about. So thank you for that. I'll be brief. This was a 20-year ago vision. We started in West Fort Worth, the Sendera Center. We had like 50 folks in the room. And it was us largely on stage talking about this or long-term care or this new product. I tell you, just like everything in life, we learned the hard way, right? We learned, and it was fine. It was successful. We had people come, but it was not near as successful as it could be. And a light bulb went off probably 2 or 3 years in. We went, you know what? What if we took all the product stuff out of it? What if we didn't get up there and talk about anything that was insurance related, and we made it about the audience? We made it about them and gave them a reason to come that was, about what they deal with. So being that it's over half the room's HR, now it's evolved into a lot of controllers and CFOs and benefit and risk managers. But we just polled them every year. So what do you want to hear about? And then we changed our speaker lineup to be truly leadership development centered. So now it's powerhouse speakers. It's grown now, Mike, to 2 locations across Texas. I think we have 700 companies at last year or something. It's huge, but it doesn't feel huge because you're in small tables. They still get to meet and mingle and some intentional break time. And the point of it for me, Gus Senior used to always say, and it's like our motto in our office: don't tell me how much you know, just show me how much you care. And I love that because that's really how we try to live every day. And that summit is designed to, if you don't leave there feeling good, then we've done something wrong. You should be energized and empowered and something you can take back to your teams and invest in your own people. And that's the purpose of it now. So I think that's partly why it's grown a lot. Hub's helped that a lot too with the stuff they've brought to the table and helped get it out there. But it's more of a bring your current leaders and your emerging leaders and let them learn together and hear from some speakers about all kinds of topics versus product.
And we're going to include in the show notes links to the upcoming dates and links to register for those conferences too.
Yes, sir. That'd be great. End of August 27th in Hurst, August 29th in San Antonio. So we'd love to see anybody there that's a listener on this great show.
Well, thank you, Matt. I appreciate you joining me today.
Thank you, Mike. Appreciate you.
And thank you for listening. You can comment on this episode or search our previous episodes at goodmorninghr.com or on Facebook, Instagram, or YouTube. And don't forget to follow us wherever you get your podcasts. Rob Upchurch is our technical producer, and you can reach him at robmakespods.com. And thank you to Imperative's marketing coordinator, Marianne Hernandez, who keeps the trains running on time. And I'm Mike Coffey. As always, don't hesitate to reach out if I can be of service to you personally or professionally. I'll see you next week, and until then, be well, do good, and keep your chin up.